My student loans went into repayment. Now I can get a mortgage.
Is this person crazy? Can it be? Can student loans going back in repayment help a buyer approve for a mortgage? I'm Bob Fensterer with the local lending pros at Green Tree Mortgage, and you're watching Mortgage Hacks. On October 1st, all the student loans that were put in forbearance for the pandemic went back in repayment. Sounds like bad news for people trying to qualify for a mortgage. Did you know it may help people who didn't qualify for a mortgage before? Sounds crazy. How can this be? You have to start paying on something and it actually improves what you qualify for? Believe it. Here's how it works. When a student loan goes into forbearance, payments are suspended. We as a lender assume at some point payments will resume. If there's no actual current monthly payment, we assume one by using a factor. We assume a monthly payment that is 1% of the loan balance, or 1/2 of 1% of the balance, depending on the loan program. And we count that as a monthly payment when we calculate the debt-to-income ratio. Remember, when a mortgage lender evaluates a loan, they look at debt-to-income ratio, which is the percentage of your monthly income that you're spending on the monthly mortgage payment plus all your other monthly obligations. If we assume a large monthly student loan payment, it effectively crowds out the size of the mortgage payment you can approve for. A lot of people before the pandemic were on what's known as an income-driven repayment plan. Based on their income, their monthly student loan payments may have been substantially lower than the 1% or 1/2 of 1% that we would use as an assumed payment. When their loan went into forbearance, mortgage lenders were made to use the factor, assuming a monthly payment higher than the actual payment, hurting their ability to approve for a loan. Let me give you an extreme example. I recently worked with a person who had a $180,000 student loan debt. When the loan went into forbearance, for mortgage qualifying purposes, we had to assume a monthly payment of 1/2 of 1% of $180,000, or a $900 a month payment. This person was working for a not-for-profit, and the $900 payment effectively killed their debt-to-income ratio, so they couldn't qualify for a mortgage, at least not for a house they wanted to buy. Fast forward to today. Now that they're back in repayment, the income-driven repayment plan is just $153 a month, and their debt-to-income ratio is allowing them to approve for that 3-bedroom, 2.5 bath they've been dreaming of. So, here's the hack. As student loans go back to repayment, a new income-driven repayment program has been rolled out, the SAVE program. Compared to the pre-pandemic plan, it has added interest and debt forgiveness elements that everyone should check out. Have a client that's not on an income-driven repayment plan? Have them go to this site where there's a calculator that will show them what their income-driven repayment will be, as well as links to information about the program and an application. Look, a lot of people will think twice about buying a home now that they have to start repaying their student loans. But those people that are still ready to make a purchase may be in a better position to qualify now than they were during forbearance. For more tips and tricks on how to approve for a mortgage now that your student loan is in repayment, call me, Bob Fensterer, the loan officer extraordinaire with the local lending pros at Green Tree Mortgage. The number is 856-341-6636, and my phone is always on.